In this week's video, we'll take a detailed and fact-based look at Shiller's P/E ratio, allowing us to answer the question, are extended valuations a showstopper for stocks? This is a daily chart of the S&P 500 index. This is calendar year 1992 on the left side of the screen, and into 1995 where my cursor is. These green, red, and blue numbers are Shiller P/Es, or the CAPE ratio. Since we've covered this period numerous times in the past 18 months or so, clients and regular viewers know that we had sideways consolidation here, and then early in 1995 we had a bullish breakout. It's logical to look at the 1995 setup because in the present day, 2018, we have numerous charts that feature long periods of sideways consolidation and then a bullish breakout. The global Dow, a long period of consolidation followed by a bullish breakout. And this is the box in the bullish breakout that we are watching after the US election and early in 2017 for the NYSE Composite Index. And we've also covered in the past a very long-term consolidation box for the value line geometric index. Price came down to the bottom of the box numerous times here in the 1980s and 1990s. We visited the top of the box in 1998. Price was rejected. Visited the top of the box again in 2007. Price was rejected all the way down to the bottom of the box. This level is basically the same as these levels here. As we rose off of this low, we were still inside the box. Price again was rejected. Here we came down, and we now have a successful bullish breakout. This is the first time price has been able to exceed these levels, and this chart is as of January 8th, 2018. In the detailed analysis that follows, we're going to focus on three questions. Do valuations or the Shiller P/E negate the recent bullish breakouts? If we examine similar breakouts in history, is the CAPE ratio helpful as a market timing tool? And the third question, can charts be helpful near a major market top? Right off the bat, if we were trying to use the Shiller P/E ratio or CAPE as a timing tool, it would be very, very difficult to discern in this period between a bottom and a top. We have a bottom at 19, a bottom at 20, a bottom at 20, a bottom at 20, and then we have tops at 21, 21, and then the breakout has a ratio of 21 as well. Therefore, nothing jumps off the page here that the Shiller P/E was helpful as a timing tool in this box here. Let's set the stage with the known facts. When we had this bullish breakout in 1995, the Shiller P/E in this area here was 21. And when we looked backwards from this breakout period here, if we went all the way back to 1881, the median Shiller P/E was 14.95. Therefore, if I'm trying to make decisions based on valuations right off the bat, I might be skeptical. 21 is a lot higher than the median Shiller P/E of 14.95. And in the rearview mirror, I have two fairly substantial tops that occurred with a Shiller P/E of 21. If we fast forward into 1996 from a valuation perspective, things really just get worse. We go from 21 to 23 to 24 to 25, all the way up to 26, which is quite a bit higher than these peaks here and quite a bit higher than that median of 14.95 looking backwards. Given the Shiller P/E of 26, it would have been very, very easy to say right here, stocks are way overvalued, valuations are extended, the rally will fail. The charts that you've been looking at and presenting are meaningless because of these valuations, and I can't own stocks at these valuations. Based on the information that we have at this point in time, and if I'm using valuations as a guide, these are relatively prudent statements. Our goal here is to try to figure out if we were using the Shiller PE after this bullish breakout, would it have helped us navigate from a point A to a point B? As stocks continued to rise, it would have been very, very easy to remain skeptical if I'm using the Shiller PE as my primary timing tool. At this point, I might say if I'm patient, valuations will return to their historical norm and I can buy at a more favorable entry point. Or I might say the Shiller PE is almost double the median valuation between 1881 and 1995. I'm staying out of this market. It's risky. All of these numbers here are quite a bit higher than that median that we know based on history looking backwards this way, and they're quite a bit higher than these peaks here. And if you know your market history, you know the S&P 500 rallies for 3 more years. So if I tried to be patient, did I get a better entry point from a valuation perspective at any time over the next 3 years? Or would it have been prudent to sell my positions based on these extended numbers here? Given our objective is to navigate between a point A and a point B that might be several years down the road, after this bullish breakout here, a favorable entry point never came. Why is it important to understand how we might have been thinking at this point here based on the data that we had in hand? Because this setup that we have here is very, very similar to the setups that we just showed. While it would have been nearly impossible to predict at this point here based on the data that we had in hand, if I said I'm going to wait for a better entry point over the next 1,865 calendar days, a better entry point never came because this number went up. It never went down. And if we said I can't own stocks here because valuations are extended, I'm getting out. Even if we had waited 8,367 calendar days, a better entry point never came. The S&P 500 never revisited this level here. And if you said you were waiting for a better entry point here, you're still waiting in calendar year 2018. And this is the key takeaway here. Based on the information that we had in hand in 1995, it would have been nearly impossible for most to fathom the Shiller PE ratio was going to hit 44 over the next 5 years, and the gains in the stock market would reach life-changing levels. The Shiller PE of 44 that was reached almost 5 years later, that's almost 3 times larger than the median PE that we had in hand here when stocks broke out in 1995. Let's assume at this point here I said this is a false breakout, no possible way anything good's going to happen based on valuations. How much upside would I have missed? The answer is from this point here in 1995, which is February 1995, until the peak in calendar year 2000, the NASDAQ gained 539%, the S&P 500 went up 217%, and the Dow tacked on an additional 196% from this point here to this point here. And based on a median PE of 14.95, and the fact that we recently had a top at 21 and a top at 21, it's very, very difficult to understand how we would have used the Shiller PE as a timing tool. And in fairness to Shiller, that's not what it was designed for. Our objective here is to see if we can use it in conjunction with the CCM market model as a timing tool. And based on this chart here, it's very, very difficult to say the answer to that question is yes. And psychologically, if you say I can't get in here because valuations are extended, it's very, very difficult with your ego to say I'm going to get in at a higher valuation level. Very, very difficult to say I'm going to get in at a higher valuation level. So once you make the decision to stay out based on valuations, you're really bringing your ego into the equation. If we missed this opportunity here, how significant could that be from a financial perspective? If I invested $1 million here at the breakout in 1995 in a reasonable allocation, 10% in industrial stocks, 65% in the S&P 500, and 25% in the NASDAQ, our $1 million would have returned 295% between point A and point B, and $1 million would have turned into, hypothetically, almost $4 million. If you're new to these videos, we're not cherry-picking the breakout in 1995. We're covering the breakout in 1995 because the evidence that we've had in hand for over a year tells us the present day looks a lot like the breakout in 1995. We covered the similar setups way back on December 16th, 2016. You can find the dated video by Googling this title here. Similar situation here, 1956 on the left side of your screen. This is the Dow. 1983 here. We have a long-term sideways period of consolidation. Right off the bat, from a timing tool perspective, it's very, very difficult to try to figure out, am I supposed to sell when the PE is 8, or am I supposed to buy when the PE is 8? Am I supposed to sell when the PE is 19 at this relatively major high here, or am I supposed to buy when it's at 19? Given valuations are relatively tame here, let's assume that if we were using valuations that we were willing to buy this bullish breakout that occurred in late 1982, early 1983. And before we fast forward, it's important to note our reference point at this breakout here, looking backwards based on the data that we had in hand, the median Shiller PE between 1881 and 1982 was 14.83. Therefore, based on that standard, valuations look pretty good here. But if we fast forward into the 1987 crash, we can see it would be very, very difficult for a value-based investor to think that this episode was over here. Why? We recently had major peaks at 8, 11, 19, 18, and 18. Now we have a major dislocation that took place with an 18, which is well above the median looking back to 1881. And recent lows occurred at an 8, a 9, an 8, and a 7. And we have to take into account the emotional toll of this drop here. It would be very, very easy for a value investor to say, I'm going to be patient and I'm going to wait for a better entry point. This is not over yet. If I were patient in the past, I was able to enter at an 8, a 9, an 8, and a 7. A 14 or 15 doesn't look anything like that. What happened next? A better entry point never came after this low here. So if I didn't enter here, I would have felt worse here and would have said, from an ego-based perspective, I still am going to be patient. I'm still going to be patient. I'm going to wait for a better entry point. Stocks are wildly overvalued. Let's assume I didn't get back in after the 1987 crash. What type of gains would I have missed if I was unwilling to own stocks at these valuation levels? From the low in 1987 to the peak in the year 2000, the NASDAQ gained an additional 1,630%, S&P 500 582, Dow 574. And based on that median PE at this breakout of 14.83, and the fact that we had highs at an 8, an 11, a 19, an 18, a 22, a 24, a 22, and an 18, is very, very difficult to understand how we could have used the Shiller PE as a timing tool, really at any point on this graph. which goes from 1956 to the year 2000. And in fairness to Shiller, it was not designed to be a timing tool. Therefore, once again, if I was unwilling to own stocks based on valuations, and I decided I had $1 million here and I'm going to sit this one out and I'm going to wait for a better entry point. If I invested in the same allocation, 10% in industrial stocks, 65% in the S&P 500, 25% in the NASDAQ, that portfolio from this point here to this point here gained an additional 843%. My $1 million would have turned into, hypothetically, $9.4 million. And if I wanted to capture that return, or even a portion of the return, valuations would not have been very helpful at all. Remember, when I'm here and I get the bullish breakout, all I know is that the median Shiller PE looking backwards is 14.83. Nobody would have thought that we were going to see a 198% expansion above this median PE. 44 is quite a bit higher than 14.83. And as professional money managers, we have to ask ourselves, can we afford to be wrong and out of the stock market for 13 years? Obviously, in our business, the answer is no. Therefore, it's not prudent for us to try to use this tool in the market model. The list of inputs that's superior to something like this is very, very long. There are much, much better timing tools than valuation metrics. The important thing is, do you have an exit strategy? But one of the great misnomers about trend following and technical analysis is the charts tell you what has already happened. When they roll over, it will be too late. Nobody is going to give back anything even remotely close to 843% when the technicals roll over here. Will you give some back at this peak? Absolutely, positively, yes. But if you've executed well between a point A and a point B, and you have a very long-term focus because you understand the type of gains that can occur after a long-term period of consolidation and a bullish breakout, there is no question that based on the facts that you have in hand after the market rolls over, you will be able to capture and protect a significant portion of a gain like this. Once again, if you're new to these videos, we did not cherry pick 1982 and 1983 after the fact, just the opposite. We covered the similarities between the present day and 1982 way back in December of 2016. Thus, our rationale for looking at the Shiller PE is to see if it could have helped us in any way navigate between a point A and a point B that could be several years down the road. And why is the 1982-1983 period important? Because it's extremely rare for the market to go sideways for a long period of time and then break out to a new all-time high and then successfully retest that breakout and push higher. It's very, very rare for the stock market to consolidate for a long period of time and then break out of the box and make a new all-time high and then successfully retest the bullish breakout and go on to make a higher high. This period here is very, very similar to this period here. Harder markets are typically followed by easier markets. Harder markets are typically followed by easier markets. And to put this consolidation period into perspective, if we put the 1995 case on the map, it's a blip on the radar. The longer a market goes sideways, the bigger the move that we can expect to get. It's obvious that this period here is quite a bit longer than this period here. Market fractals tell us that this breakout should be treated in a similar manner to this breakout. and this breakout should be treated in a similar manner to this breakout. The only difference is the length of the period of consolidation. So what's the moral of the story? We have the mother of all breakouts here. Price entered this box. The average stock back in 1983 stayed inside the box basically until the present day. We have a breakout, a successful retest, and then a higher high in January of 2018. Just as it would have been nearly impossible to fathom that the Shiller PE ratio was going to hit 44 over the next 5 years, and the gains in the stock market would reach life-changing levels here in 1995. It's possible that we'll look back in 5 to 20 years and say nobody would have ever in their wildest dreams thought the Shiller PE ratio could get that high, and nobody in their wildest dreams thought the stock market could rally for 5 to 20 years after a bullish breakout like this. If we would have gone into a conference room, a professional conference room on Wall Street in early 1983, and we would have said that the Shiller PE is going to skyrocket from 14.83, the median, at some point down the road, we're going to see a level of 44. And from this low here to this point here, the Nasdaq's going to rise 1,630%. We would have probably been laughed out of that conference room. Because when we looked in the rearview mirror from this point here, this is our perspective. And as humans, we have a tendency to look backwards and extrapolate that into the future. That's not the way markets work. They have never worked that way, and they will probably never work that way. This is quite a bit different than this. And just as in 1997, we could have said, if I am patient, valuations will return to their historical norm and I can buy at a more favorable entry point. It's possible that that may happen, but in this case, stocks went up for another 3 years from this point. And just as the levels in 1982 were never revisited after the bullish breakout, it's possible, this is not a prediction, but it's possible based on the information that we have in hand, that these levels will never be revisited again. Once we had the breakout in 1982 and the successful retest, and then we made a higher high, no matter how patient we were, these levels were never revisited again. And just as it would have been very, very easy to say stocks are way overvalued, valuations are extended, this rally's going to fail, the charts are meaningless because of valuations, I can't own stocks at these valuations back in 1996. It's very, very easy to make the same argument today. And once again, we did not cherry pick these periods. We've been talking about these periods for a long time. This is a short takes post. These charts were in the short takes post dated December 13th, 2016, over a year ago, where we said this setup here in early 1995 was very, very similar to this setup here in calendar year 2016. And we said this point here was very, very similar to this point here in 1985. And so far, based on the gains that we've seen since posting that analysis on December 13th, 2016, we have no reason to believe that this breakout will fail. Thus, a fair question may be, given the valuations that we have in hand, where do we go from here in January of 2018? Point number one, we're not making a forecast, and we were not making a forecast back in 2016. We were simply making probabilistic statements based on the facts that we had in hand. In this December 2016 video, we weren't making a forecast, we were simply making probabilistic statements based on the facts that we had in hand. And from a strategy perspective, how do we discern between volatility to ignore within the context of an ongoing uptrend and volatility to respect, which is ultimately our exit strategy? We'll take the latest set of facts, very similar to the facts that we've covered in this video. We'll plug them in to the CCM market model, and we will ask, based on the output, are we allocated properly? If the answer is yes, or we're not sure, leave it alone and give the bullish trends the benefit of the doubt. Eventually, during a correction or a pullback or a new bear market, the answer will be no. And then we simply make an allocation adjustment to get back in line. And just as we've done over the past 12 months, or in calendar year 2017, we will continue to wake up every day and repeat that process with an open, unbiased, and flexible mind. So we've already addressed these questions. From a historical perspective, does the Shiller PE in the present day negate the breakouts? Based on history, is the CAPE ratio helpful as a stock market timing tool after a bullish breakout? And if you're new to these videos, can charts be helpful near a major market top? The charts that we've covered in this video are big picture or forest charts. The model also uses shorter term or tree charts. We're using generic daily moving averages here to illustrate basic concepts. The left side of this chart here in 2000 looks quite a bit different than the right side of this chart here. From this point here, after we could see this, measure it, and put it in a model, after this point, the S&P 500 lost an additional 46%. We didn't need to forecast anything. We had this in hand. Similar situation here. When the S&P 500 was still at 1,500, when we could see all of this, this looks quite a bit different than this. When we could see this, measure it, put it in a model. After this, the S&P 500 fell from 1,500 down to 666, which is an additional loss of 56%. So in the present day, do the facts that we have in hand look anything like this? Or do they look more like these constructive periods here? After we could see this, measure it, and put it in a model, the S&P 500 gained an additional 156%. Based on the facts that we have in hand on January 11th, 2018, right now, everything looks good. We'll wake up tomorrow with a flexible, unbiased, and open mind and repeat the process. And the exercise that we've gone through today helps us remember how big market gains can be after a long-term period of consolidation and a bullish breakout. And that helps us keep our eye on the primary objective, which is navigating between a point A and a point B that could be several years down the road. We know with 100% certainty at some point in calendar year 2018, we're going to see some volatility, and most likely it's going to be greater than the volatility that we saw in the relatively tame 2017. Therefore, while the seas are calm, we should be mentally preparing ourselves for the fact that we will have to deal with some volatility over the next 12 to 14 months. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.